This session here, we're going to talk a little about assessing affordability, credit and collections risk. So we've got another good group of speakers, just to introduce them really quickly. So we've got Dawn Brown, who's the Chief Risk Officer at Tandem Bank. They're a challenger bank, experts in savings, lendings and green consumer finance. So, Dawn. We've got Jon Timmis, who's the head of credit risk at 24/7 Money. So they're a car finance provider focused on using technology to really put consumers in control. So welcome, Jon. We've got David Marr, who's the relationship director at Receeve. And Receeve are a collections recovery platform. So they use data really to try and find dynamic customer solutions and sort of interact with customers. And then lastly, but no means least, we've got Fenton, who's the head of digital development at Zinc Group. So, and Zinc Group are receivables management company. So welcome very much to the panel. Thanks very much for joining me. Now, who watched? Apparently, the autumn statement happened when we were actually talking. So who's up to date on that? So I'll just give you that because we're going to talk a little bit about. My first question is going to be about what's your reaction to it, and in terms of like some of the measures that are out. So if I just quickly run through it if I can. So they made some changes to minimum wage. It's gone up from £9.50 to £10.42. They changed the top rated tax threshold, but they froze income tax allowances for income tax, inheritance and national insurance. Some changes likely in terms of dividends and capital gains thresholds. The energy cap, which was probably a reasonably big thing for us, that was due to end, I think, after 6 months. They now put that in at 3,000 on average, and it's on the rate. It's not a cap. It was 2,500 for the average household. Now it's going to be 3,000. And they think they've extended it, and there's means-tested support for lower income or pensioners and those with disabilities. I think it is. There's a windfall tax on oil and gas that goes from, I think it was 25% to 35%, so that's going on. But there's also this interesting 45% tax on generation companies, energy generation companies, which is quite interesting for the renewable sector, I think. So when I looked at that. Economy is forecast to shrink, unemployment's due to go up, 9.1% inflation, and some changes on social care, which were mooted, are sort of been delayed till at least after the election. So those are summary changes. For those who don't know, I mean, I think that's my first question, which is we've now had an announcement, and we're going to talk a little bit about affordability and assessing affordability. I mean, how do you think those kind of changes will sort of like flow through into the collections environment? I know it's sort of breaking news, but anyone want to take that?
I'm just going off the kind of the chatter that was going on internally at our end on our Slack channel, and the feedback we were starting to get from clients. The biggest thing is still the energy side of things, and I suppose it's not so much what the values are. It's just still very ambiguous. And I think it's still causing a lot of doubt in customers' minds as to what they're going to be paying come April. I'll be honest, I don't know what I'm going to be paying come next month. So, I think that's the biggest thing that a lot of our customers are talking about. And I know personally I'm talking about that as well. But I think what that's then kind of, for our client base, we have some utility providers, but we also have a diverse range of other different clients, and they're all concerned about this because obviously it has an impact on their customer base to pay for things. So that seems to be the overriding thing I'm getting, but that may change as the day goes on.
I mean, Jon, we were chatting just a little bit over lunch around the amount of change that's coming through. This is another change that's coming through. In some ways it doesn't sound quite as big as some of the other ones, was my immediate reaction. Maybe that was intentional on the government, but I mean, how do you feel about this change coming through now? Your reaction, at least, anyway.
Yeah, I mean, what I'd say is the change is there weren't too many unexpected changes. There were kind of some positives in terms of the £3,000 on energy is not actually as bad as some were expecting potentially there. It's good to see, especially those people that are at the bottom. They're serving those people that are on benefits and things like that, seeing the caps kind of increasing in line with inflation is really helpful. I think given the challenges that they had, it wasn't actually a bad budget as such. One thing with me is, though, I don't know how long this will stay for, because it was 3 weeks into last changes and things like that or whatever. So I'm hoping for some stability as much as anything else. The one thing that I can't go out this room understanding, though, in the future for the customers coming to ourselves is what will happen to the council tax. Because you've given them the ability, you've given the local councils the ability to raise your council tax beyond 5% increase, year-on-year increase, which is great. I understand, councils are under huge amounts of pressure, but I can't tell what councils are going to do with that. They haven't put another limit on. It's just basically like you can have a potentially unlimited amount. And that is at a council-by-council level making those decisions. So it's very difficult for me at the moment in time to understand what that's going to look like, especially for, 2 councils have gone bankrupt. What will they have to put up their rates by to kind of balance the books again?
Yeah. And my council's gone bankrupt. Dawn and Richard.
Yeah, I thought it was quite interesting. I don't think there were any particular surprises. I suppose what I was sort of more focusing on is actually some of the economic forecasts. Inflation, they were saying, was 9.1, I think, which is, it's obviously lower than we've got now. So what does that mean? Is it, bringing it down, but then over what period? And I don't know the detail around that. But I think the other key one for me was around the unemployment, forecasted to go up to 4.9, which actually sort of historically isn't that bad. And from a credit risk perspective, that for me is the key thing, is unemployment. It's affordability is really, really important, but the one thing that's going to stop people paying is whether they've got a job or not. And actually, if that forecast is right, then actually things may not be as bad as some people fear.
Yeah. Richard, what's your kind of view, your customers?
I think for me it boils down to what we've seen today is pretty much a nothing. It's a reaction. And it was a reaction because we needed a reaction to everything that had happened 3 weeks ago. It was more of a steadying of the ship than picking a good route. That's my personal opinion. And I think the issues that are out there centre around the cost of living, inflation, interest rates, what it costs to get the weekly shopping. Those are the issues that need addressing, because those are the issues that actually affect the people that we're dealing with. To put to increase taxes in the way that they've done on higher earners, that's fine, makes perfect sense. To increase windfall tax, yes, it makes sense, but what does that mean to the man and woman in the street? Probably means very little at this particular stage. We've been talking about a storm coming, and I don't think there is actually a storm coming. The storm's here. The storm was the pandemic, the storm is the cost of living, inflation, interest rates. What we've got coming is the breaking of the dam. That's actually what's coming. Everything is currently being held together. And I think we've addressed that a couple of times this morning, that we don't really see too much influx of people having an inability to pay down their debts. There is some credit available out, but those banks of protection are about to burst. And I think we'll see that certainly in the second quarter of 23. And that's when we're going to, really need to see budgets of significance.
Yeah. So, I mean, that's very much what you're seeing in terms of, like, when you're looking across your book or, the people you deal with, is like, it's still not coming through yet, but it's just the pressure's been building.
It's like stepping outside and feeling those droplets of rain.
Yeah.
And they hit you in the head, and it's still sunny, but you know something is coming.
Yeah.
You can sense it. It's definitely out there, but it's not actually happening yet. Everybody's being stretched, but nobody's being pulled apart as a collective yet. But I think this budget today was always going to be politically driven rather than an actual real solution. No matter the party in power, it was very much a political autumn statement and very much a reaction to what had happened to the markets 6 weeks ago.
I mean, I suppose in terms of like cost of living, I suppose particularly inflation, it still comes back to that inflation piece we're talking about this morning. I mean, and Dawn, I'm quite interested in just giving, and Jon as well, in your position in terms of like, are you approaching your approach to credit risk either in terms of like, credit granting as well as the collections piece? I mean, sort of how are you having to react to think about that? Because some of it we know is here now in terms of like cost of food, but it not necessarily be seen in things like unemployment and some of the, even things like delinquency rates as well.
We are definitely starting to see some deterioration, and we can see it that it generally is the people that have less affordability when we actually went through the income and expenditure assessment. Is those people that could afford and they had a buffer there, but actually were on the tighter end. So we are starting to see some of that just more on the personal loans portfolio, which is where we expected it to hit first. And we are starting to see sort of at the back end when customers are rolling into collections, then they've gone into arrears. Actually, it's the ones that our scorecards are telling us that are least likely to cure that are rolling through as well. So we are starting to, just over the last...
So it's very much happening at the margin. In terms
it
of
is happening very much at the margin.
Yeah, which is kind of what we're talking about. It's not affecting... It's affecting everybody, but it's those that are sort of tripping over the edge, sort of changing the margin.
Yeah, and I think, my view is that actually there's a sort of polarisation within the economy, as a whole. There's people that are really starting to struggle with the cost of living crisis. But then, if we look at the other end, we're obviously deposit takers as well. But there is plenty of people still wanting, savings products. So and whether that's because they are coming out of fixed rates and putting things into instant access, so they've got access to the funds, or whether they've saved up some money during COVID and have got that little bit of extra protection now. But we do seem to see that divergence at the moment with some people that are definitely struggling, but actually some people that have that cushion in the background to withstand it, as long as it doesn't go on for too long.
Yeah, John, what's your kind of view?
Yeah, for me, I'd say that one of the things we are seeing more than the amount of people that are rolling into severe arrears is we're seeing a lot more people staying at their current arrears level. So they're finding it harder to make up any arrears repayments, or they're going to have to go, or they have, rather than basically, I can make my additional payment up next month. It's like, okay, I can make that additional payment I need to make over the next 4 months. I can maybe afford another £50 here or there. I think that's one of the things we are starting to see. But we are squeezing everybody at the moment in time, and if this government doing a initially badge up, hopefully someone who might be cured a little bit this time around, hasn't helped our customers either in terms of, because the rates we pay, the interest we pay to go on in terms of the finance coming into ourselves that we then could loan out is higher, which means that even without changing anything in the affordability and the cost of living, I am making those loans less affordable because it costs more for me to buy it. I have to pass those on. So even without the cost of living thing, if the cost of living themselves were not increasing, the Bank of England base rate, the gilt rates going up and things like that, they would all be impacting my business anyhow. Yeah.
So all that affects, I suppose, affordability of loans because the rates are higher. And
it does, yeah. At the end of the day, because I am a lender, but we're also in the kind of the part of the group is Car Finance 24/7 as a brokerage, and all lenders are having to increase their rates because the cost of borrowing has increased so much. Yeah,
I mean, for the two of you actually, in terms of, how are you seeing that in terms of is there still growth in the market, do you think? To people, Dawn, you were talking about there are some people who are still looking for product.
Yeah, absolutely. Yeah, we're growing both on the deposit front and on the liability side. So yeah, there's definitely growth out there on, for both for lending and for savings products.
And so what's the sort of the steps you're taking just to protect yourself from a risk point of view? Is that just in terms of just more data or better modelling?
More data is obviously is great, but we've kind of tried to be a little bit more proactive just in terms of affordability assessments. And whilst we've always had a buffer, we've actually increased that now as a sort of requirement so that we are we're making sure that we're not taking on people that are at the more marginal levels. And I know that there isn't always a correlation between credit score and affordability, but we have also tightened up on credit score as well. So we are taking some sort of proactive measures at the front end just to sort of rein in our credit risk.
And that does to account for things like future affordability, or because I think we talked about. So it's 9%, I think, the inflation rate they're saying here, but it's 14%.
We've factored in inflationary increases into that.
Yeah.
So as well as having a requirement for a bigger buffer, we've also worked in quite a big increase in inflation, and actually for fuel and oil and fuel costs, that should have increased that even further, just given the current market.
Any other?
I suppose, like, we're obviously slightly different to the rest of the other panels here in that obviously we're a software company in most regards, but one of the things we're seeing from our client base, we have a number of BNPL providers on our as users of our platform. What we've started to notice over the last 6 months is, firstly, they're processing more cases of people going into arrears than they've ever done, but also their client bases are growing as well. Now, we don't have sight necessarily of what their product's being used to pay for, so we don't know if it's being used for, say, a more of an essential product rather than a new pair of trainers, for example, but we are seeing a surge in those areas, which, I'll be frank, from a business perspective is good for us, but from a society, the general marketplace, I think this is a problem, and we're not really going to see as to what extent that is. I suppose the one thing that, and I don't think it counteracts it that much, but I was at the FCA on Tuesday, and I needed to actually get a bow tie for tonight, so I nipped into Westfield, Stratford next door. But what I'm noticing, and I'm not a huge user of shopping malls, but I'm starting to see that you are seeing physical advertising for BNPL products now, and it's specifically targeted to retailers that were in that Westfield, so Apple and many other providers, and I've never seen that before, and I think this is the first Christmas or period where they are going all guns blazing. But as I said, what we are seeing is the potential negativity of this, that individuals are going down this BNPL route because it's the only option that's available to them, and I don't know when we'll see the true ramifications of that.
And so I suppose what you kind of explained there, I get John for you to comment, is because you can get negative selection, I suppose, from that, in terms of so people go to wherever the option is where they can actually get credit, so people are credit seeking. So unless everyone erases their cut-off scores, then it's going to go to where people can get it because there's still a need for it. And then is that a risk in terms of collections downstream?
Yeah, there's always going to be a risk of those kind of things in terms of so there's a risk from a credit risk perspective for those facilities not even being there as well. It isn't just the fact that they will go to the lowest denominator or the easiest one. People mainly go to buy now pay later because it's frictionless and they don't,
it's easy,
and they can generally know they can be accepted straight away no matter what happens. But it's also the fact that those things, and including the payday lenders and things like that, whatever, it's kind of important for me that those people are there as well, because those people that are that have got thin files, that have got limited credit experience before, then they've got nowhere to go if those people don't exist, right? I want those people to exist so they can, for the people that are struggling, so they can have those things to get over those periods where their expenditure is going to go over their income. I can, I've got £50,000 I can spend on a credit card tomorrow if I wanted to do so. I can dip into a facility that's already there, existing, and got loads amount of money that I don't need. But the people down at the bottom haven't got anywhere else to go, so it's important that they have those kind of facilities there.
Yeah. Well, there's a comment made here around, it's almost like is it too easy, so you can apply for multiple offers or whatever it is, and it's just become almost like too easy and you get this, everything adds up, right, which is probably more of a debt advice type comment, because you don't get to see it as a creditor, right?
No, there's a lot of information to get to the stuff you don't get to see as a creditor that open banking is going to be really key going forward, because I think the vast majority of credit models are kind of broken now, because you can't rely on the customer's ability to repay in the past being reflective of what we're in now, which is an extremely different situation that no one has ever been in before. This is different than it has ever happened. To understand the customer's behaviour from the open banking is so much more important now than it ever has been before. To know that basically in times of stress that they've had previously, when they have had that they've cut back on their non-essential stuff. The fact that, okay, I don't know, their income could have been great 2 years ago, but I know that when they had that spike in expenses 2 years ago, they cut back on they didn't go to the takeaway so many times and things like that, whatever. To understand how their behaviour changed under times of stress before. That's why we're doing an open banking check on everybody that comes in now. We won't sign someone on until we've done an open banking check in terms of like salad money over there. We just wouldn't do it because it gives us so much more behaviour that is more useful now than a system which is 90 days in the past, potentially, in terms of credit file information. And it also isn't necessarily reflective of the situation they're going through now. Yeah. Same affordability models. You know, my old affordability models could be based on whether another customer can afford it now was reasonably fine. But now it's like, I will have to have an affordability model that says, I know the affordability over the likely 5 years that you'll take out this loan is going to peak at that point. So I've got to pass the affordability. So I had to change so many things about the whole model and pull it apart for the changing times we're in now.
I know we'd had a talk about open banking, one of the online sessions we had with Credit Connect around, I think it was the order of direct debits. I think that was the example we were using in that discussion, which was quite interesting in terms of like very kind of subtle changes, wasn't it, in terms of what that might kind of mean. So just on rising cost of living, I suppose the impact on credit risk, I suppose on affordability, and Rich, I was going to ask you about, I mean, there's a piece yesterday, I think it was, saying about, I mean, there's only so much you can actually save in terms of like cutting expenditure. I mean, you know, is income going to be the issue? And there's a question here around, right, what's going to break first? I mean, is it the income piece is going to break first, and what part of the dam that you talked about is going to break first as well? Well,
and I think it's interesting when we talk about behaviour, when we're looking at predictive models, and in particular, when we're looking at assessing affordability, customers completing I&E forms. It's 2 years ago, completing an I&E form, it's going to give you an idea of behaviour and spending patterns. Completing an I&E form today is a bit like taking a photograph in the garden at midday and then taking the same photograph at midnight. It's that quick. It's changing. It's very, very fluid. So the information that customers are giving you in terms of what they're spending isn't changing as a result of their behaviour or their circumstances. It's changing as a result of the market itself. It's changing as a result of the fact that inflation is through the roof, that utilities are the highest they've ever been, and there doesn't seem to be an end in sight. Fuel at the pumps is very expensive. Mortgage rates are going up. Rent is going up. Quite an interesting personal anecdote. We've just recently moved house, bought a home, and we were renting accommodation until we bought a home, and we were paying, don't mind telling you, £650 per month for that accommodation. Within 2 weeks of us leaving that accommodation, the same house was on the market again for rental at £900 and disappeared in 3 days. And that tells you everything you need to know about what people are dealing with. And we're not talking a particularly nice house either. It's just a bog standard 3-bedroom, toilet downstairs, toilet upstairs. And somebody somewhere is now paying £900 to live in rented accommodation. They've no chance of getting into the purchase market. And they're going to have all the other aggravated costs. So in answer to your question, which do I think is going to break first? I think it's all breaking simultaneously. I think people's pay packets aren't doing the job that they used to do. There's fewer opportunities to predict your own financial position. Each time you turn on the news, each time you visit the high street, something has changed. If you get a win, you get a loss. And that's the issue. And I think that's the thing that we need to bear in mind when we're talking to customers, is that today's position isn't literally tomorrow's position. You know, we're not just talking metaphoric, we're talking literal changes within 24 hours.
And how do you factor that into the assessment in terms of actually predicting what it's going to be? Because, I mean, the customer might not know. It's easy to report on what you know today, but it's, I mean, just even as we see today, right, it's quite hard to predict the future. Well, I mean, is it?
We sit at the back end of this process. So collections is where we sit. So by the time we're engaging with the customer, this isn't about an application. This isn't about assessing you to see if you can afford a particular financial product. This is about getting you back into a position of repayment. So we're kind of in a better position than lenders because we have far more flexibility because there's nothing at stake. Everything has been lost at this point. So it's about letting the customer know that there's flexibility there, that when your position changes, not if, when your position changes, for the better or for the worse, stay engaged. And that's the key element for our side of the industry, is keeping the engagement there, making it easy for the customer to alert you to a change of circumstances so that they can make adjustments up or down in their payment plans. And I think we need to recognise, particularly in our side of the industry, that might happen 2-3 times in a 12-month period as people adjust and begin to find that balance point. There's a lot of newbies coming into our sector. And what I mean by that, the class of 23 is going to look very different to the class of 2015. We've got people that are used to managing themselves in a resilient way in our sector. The people that we generally deal with know how to do that. They've been in this situation before or close to it. It's come as no surprise. But we're getting people now that are going to come through in the early part of 23 that have no clue. They're going to be novices at managing themselves through particularly financially difficult situations. They didn't see it coming. And rightly so. Who did see it coming? Who saw this coming? We got through the pandemic and we kind of all took a collective sigh of relief, and more fool us. Everything that the world just went, actually, no, let's have a bit more fun. And everything's just gone sideways again. And there's a lot of people being caught off guard.
And how do you feel about the engagement piece? I don't want to sort of repeat the last session, but I mean, in terms of like engagement, what's the best way of getting hold of those people? What's the best way of getting hold of those people?
Personally, I think it's creating as many opportunities as you can for a customer to engage. There's lots of discussions about traditional contact centres. Do you use Royal Mail still? Do you use digital? I think at this moment in time, nothing's off the table. I think digital, the clue's in the title, I guess. I have a little bit of a bias towards digital. But all options should be available. Making it as easy and as simple as you can for the customer to reach into your business and have that conversation. I mean, our industry, when I joined this industry, there was 2 things that was different. One, I owned a comb, and 2, we approached debt recovery in a very different way to the way that we do now. It's customer-led now, and rightly so. It's letting customers know you're still a customer. Just because it's hard times, engage with us. But to do that, you've got to make it as simple and as frictionless as you can.
Yeah, I mean, and David, I was going to come to you just around sort of, I suppose, the engagement piece, but I suppose in terms of like understanding affordability and those kind of things. I mean, how do we get a hold of people? I mean,
but one of the things that we do and what we've done in kind of led by a lot of our customers was our platform generates a lot of data around kind of what a customer does with different communication methods and how those customers interact with them. So what we've done is taken that data to then kind of give our customers an idea of the different success rates of different means of communication. So that's a key element of it, because then obviously it means delivering that message gets to those customers and they can take action off it. So going back to obviously from an affordability perspective, what a number of our customers have started to do is they've started to kind of preempt the situation where the customer's going into a scenario where they owe money, shall we say. So what the customers are starting to do is they're starting to smooth the process over as to the customer at that point isn't necessarily needing to communicate with them because there's an issue, but they're trying to make the whole process of, if they do need to communicate, it isn't a negative. It's part of everyday life, shall we say. So it's trying to reinforce the way to interact with the third party it's a normal thing, if that makes sense. But what we're seeing is a lot of our clients are worried about, as was pointed out, early part of next year, in that they think that will be the critical moment. But what they want to have is, at that critical moment, they have customers that are comfortable interacting with them when it comes to that stage. So it's even before they start looking at the affordability
so
of
you're
things.
finding that people are trying to get hold of people like now in anticipation of that, so there's some of that?
Correct, yeah. They're coming up with reasons to interact with those customers so that they can obviously, in some ways, part of it is to see what methods those customers are most comfortable utilising, but it also normalises a conversation that will be a lot harder in 6 months' time, potentially.
Well, links to the previous two sessions to a certain
Yeah.
extent. Yeah. So I want to talk now a bit about data, and obviously we're in a rapidly changing kind of economy. People's lives are changing, expenditures kind of changing. We use models, I suppose, to assess risk, assess affordability, and just this idea around whether. I just want to ask you two guys in the middle, like John and Dawn, just around, is that how much of a problem is that causing in terms of assessing affordability, and how is it, and how is that changing? I suppose where you need to set scores or really understand how the models are performing as well. It feels like we're almost like operating a little bit more fog than we were before.
Yeah, I think from my perspective, and I kind of alluded to it a minute ago, that you just need to be a lot more proactive.
Yeah.
I don't think things like the affordability models are broken in themselves, but I think you just can't rely on, most affordability models I've seen have always used ONS data, but, which is obviously, certainly out of date even by the time you get it. So it's looking at, well, actually, how can I use that with more recent data or forecasts to actually up the expenditure side of things? If you assume that income stays the same, but actually you up the expenditure, can you use your models in that way? And that's the way we've kind of come at it. So I don't think the affordability models themselves are broken. I just think you have to just.
What about rebuilding models? Are they looking for like increased frequency of rebuild, or is it they're still the same? It's the parameters that kind of go in.
Yeah, from affordability side, yes. Scorecards. I'd expect to certainly recalibrate them regularly anyway. So, as part of the bog standard scorecard monitoring, you'd start to see if things were to decay a little bit. So, no more than. We have looked at, just sort of variables to see if certain things are becoming more predictive, and things like, access to revolving credit certainly seems to be quite predictive at the moment, where it may not have been a little bit, a while ago, but, and that might start looking at getting those into the scorecards, but at the moment it's just recalibration.
Yeah, so at the moment it sounds like it's largely the same, it's just the actual values are changing rather than the actual dynamics.
Yeah,
but you're monitoring it.
Yeah.
Yeah. John, to get your perspective, I suppose it's also interesting to work out, you talked about open banking before. What are the extra pieces? Is there extra data that could be useful in terms of, because it feels almost like where the predictiveness of the model maybe isn't as far out as it was before. We might be looking at, what is someone going to default in 6 months' time before, but now it's sort of like it's much nearer just because of the recency of data. But, is there extra data that can help us? And what's your view? Is that even right?
Yeah, in terms of open banking, there's loads of extra data that can help. Part of it, as I said, is the fact if you understand actually what the customer is going through at this moment in time. Because credit files are up to 90 days out of date when we get it, because obviously it takes, the credit providers update it once a month, and then it has to be filled through and things like that, whatever. So that information in itself is out of date by the time you got it. But also things like whatever score you want to pick, whether or not that's Gauge or RN or I can't remember what the Equifax one, the Experian one is often. Whichever score you're using, that's mainly based on previous behaviours, and almost everyone's scorecard has got some element of that scoring, but that doesn't take into account as much in relation to the recent things that are happening, and all these things are happening very recently. Those models themselves are not very predictive comparatively to the open banking, where I can see how that customer's starting to spend more money. I can see that they're starting to go into savings, for example. I can see not just the bad behaviours, but the good things, the things that make it less risky for me as a customer, to take on that customer. If I can see that customer has regular money that they put away in terms of savings, I've never got that information before in a credit file, because I can't get that information in a credit file. They could have £5 million in their current account, and they wouldn't tell me from a credit file information, because they can only tell you what is actually credit, how much the customer is borrowing. So I can get so much more information in relation to it. I can, from myself, in terms of, for the motor finance perspective as well, I can tell things like whether or not you take care of your car, how much money we expect you to go up in terms of your petrol. When petrol goes up, well, I know from the amount of petrol you generally buy in a regular month, I can make a prediction in terms of how many miles you do, okay, and if the petrol goes up by this much, whatever, how much money would it expect to be? I don't have to make estimates based on the ONS for all the information in terms of the customer's expenditure. I still have to account for how much those expenditures are going to go up in the future, or the energy, water, etc. But I don't have to make estimates based on statistical models. I can be basing it on the genuine information I know about the customer. For me, it is where we have to get to in the future is that personalised result about the credit model and the affordability model, sustainability, everything we've got to take out in terms of creditworthiness. And we'll only get there by combining all the potential sources of data that we have. Yeah. That doesn't mean credit files are not useful. It just means that they need to be appended with the additional information we can get.
There's quite interesting data, and I was watching the news last night around how inflation is affecting different groups of people in different amounts, right? So, for example, and there's information for around deciles, income deciles, and people in lower income deciles have to see higher rates of inflation than those in higher deciles because of mix issues with things like energy and energy savings and housing. But also, last night they're talking about geography as well. So, in terms of like where you live, in terms of like how modern your house is versus not, how much energy costs is, how much you have to drive to work. Do you think we're getting into that kind of nuance in terms of understanding affordability at the individual level?
I think we have to, and so we have to be able to understand how much those particular costs, those particular changes will impact that individual. That, for example, that in terms of your energy, if I can say to that at a particular postal sector level, your energy could be this much, but you could have a really high energy usage or really low energy usage, and your impact of those kind of things is so much different. If you are to the point the ONS made in terms of that, say the 140 basis points difference between the lower income and the higher income deciles in terms of the impact of the cost of living. If I understand basically how much money you in proportion you're spending on food and things like that, I can account for, okay, well, proportionally, how much do I need to put it up by? So I think there's a few different things in there. Also, again, I know what I overstress, I don't know about open banking too much, but you can understand where a customer can potentially save money and potentially feed that information back to the customer, especially if you're monitoring on a regular basis. If that customer is going out and spending all their shopping in Waitrose, then it would be a huge difference if they were to go to Aldi or Lidl. If they're already on Aldi or Lidl, well, I know that customer's got less movement in terms of their ability to cope. It's not just how much money they're spending, it's where they're spending that money is kind of important. Have you got the ability to actually rein it in?
Yeah. And what about... ask Richard or and Dawn about this idea around resilience. I think we talked about it before in terms of we look very much at almost like this is how much someone can afford today, maybe factoring what they can afford in the future. But there's also potentially some people have got resilience in there in terms of savings or that how they can how much they can actually adjust their savings as a result. It might be if they're in a shared house, as an example, they might be more resilient than if they're not. Those kind of things. I mean, can we get to that level of understanding of customers within the models, within affordability models, both for credit but also for collections as well?
I think things like open banking can be really helpful on that too. I mean, to your point a minute ago, whether somebody shops at Waitrose, they've got the opportunity to go down to Lidl, or shop at Lidl. But I think that we have to give. I don't think open banking is a sort of panacea for everything. It's it is limited, but I do think we have to give some not reliance, but credence to the customer as well to have their own view on whether they can afford something or not, or whether they want to get in, whether what they're looking to buy is equal to the amount of debt that they're wanting to take on. Absolutely, we need to do affordability assessments. We need to make sure that we're comfortable with lending, but also the customer should also have some onus to actually know themselves whether they are able to afford to take on a debt. And I think that comes back to the question about resilience, that actually there are, most customers out there will know whether they will be able to repay debt. And it's us us to then to make sure that for those that can't, we then only we act in their best interest to make sure that we don't lend to somebody who actually is in danger of getting themselves into financial trouble.
There's a nice consumer duty linkage there in terms of making sure that it's the right outcomes for them, right?
Exactly, yeah.
Mm-hmm. Richard, what's your kind of view on resilience, different part of the sector?
And our experience of open banking is, as you would expect, very different. We deploy open banking, but the take-up for such wonderful wizardry technology is motivated by something entirely different. Whereas at the front end, it's a useful tool to prove affordability and get yourself approved for a product. Customers have a huge incentive to do it in 2 clicks and get the result. By the time they're talking to businesses such as ours, the incentive to push that button is changed dramatically. And for us, what we're seeing is people that are at the very, very worst end of the situation, people that are FinDiff, vulnerable customers, those are the people that open banking is useful for, because it's a full stop to the situation. It proves the point. It allows customers to go, I told you I was in trouble, and here's the proof. And it's great because it does that, and it takes a lot of stress out of the process for those individuals, because it's a very, very quick answer to our question in terms of where do you currently stand. Now, the customers that are moving towards that have some affordability to manage their position, are a little bit wary of open banking because they know the proposition is this: how much disposable income do I have to manage my position? And my position is very difficult. So they're less keen, they're less enthusiastic about engaging with open banking because they believe that our next question will be, can you increase your payments based on this information that we have? And honestly, it's not the next question. What we actually want to do is allow people to use open banking to prove that the position that they're in, if they're making a payment to us of £20 or £200 or £2,000 a month, to prove to us that they can afford it. And if not, let's look at reducing it. For the first time in my entire time in the industry, that is really one of the drivers that we have. It's that we want to talk to you about an affordable payment. It's a genuine opening line. It's not a trick. It's not a trick question that I might have asked when I owned that comb 20 odd years ago to get the conversation going. It's a very, very genuine question. But consumers are not fools. They know that this open banking at the beginning, yeah, I can get my product. I can get my mortgage. I can get the buy now, pay later. Whatever it is that they're chasing at that moment in time. By the time they get to us, it's a very, very different proposition.
Yeah. David, I suppose just your view on, I suppose, open banking, I suppose, but also flexibility in contact and those kind of things. I mean, you talked a bit before about the amount of data there is available.
Yeah.
Use that to assess resiliency as well? Or
yeah, we do have clients, and again, we're driven a lot by what our clients want to do, but we also obviously go down avenues we think that clients would be interested in. And one of the things we are starting to see from a resiliency, if I can say it, perspective is what a number of our clients are starting to look at is data around what customers, how they react to things. So I was having a conversation yesterday with one client. What they were starting to see is where they're finding clients that, shall we say, from an electronic perspective, putting their head in the sand, they're ignoring all communications, things like that. We have clients that are using that as almost like as a flag to then delve deeper. And then that's where they then start to look from the resiliency perspective to kind of see what other data they can bring in to kind of see what the state of play is. But they don't start doing that till those specific types of flags are showing, if that makes sense.
So it's almost coming into how do I identify almost like these almost like micro triggers that can then say, well, look, I want to segment that out. That might be an issue to then get further information. I mean, are there any other sort of like leading indicators that you see being used, or even for the rest of the panel in terms of like what should we be looking at to sort of flag that someone might be in difficulty?
The one last point for me is we are, and this is feedback from our client base, the open banking data is a key driver in this, in that they're coming up with their own patterns, or, if you like, those flags that are in that data. But then what they're then doing is testing the validity of that, shall we say, flag, by communicating or attempting to communicate with that customer.
Yeah.
That's starting to become something that a few of our clients are actually starting to do.
What about the whole piece around, digital collections and role of technology in assessing affordability? I mean, can purely online sort of lending and collections processes actually work? And Richard, I'll maybe go to you just as it's in the title, but it's. I mean, what's your kind of view on that? I mean, can you be purely digital, or do you think you've got to have this blend?
I think digital is crucial and becoming more and more crucial in terms of an offering. And the one thing that self-serve does is it levels the playing field between you and the customer. It takes the emotion out of everything. So the customer, particularly at our end of the proposition, can engage with, they can walk around the office, take a look at us, get a feel for our culture, and discover that actually we're not baiting traps here. We're not asking you to call back so we can trick you into a payment proposition that you can't afford. What we're actually saying is come to us, engage with us at any time of your choosing. Everything that's available through a live agent, if you make that available for somebody to see on an online platform, as long as the platform's secure, it becomes easy for the customer because there's no back and forth. There's no back and forth. Now, you're going to need traditional services at the back of that. You're going to need the ability, or the option for customers to call in, ask questions, or to dial out and send out traditional communications. But I think adding digital to any kind of communications proposition in collections is vital, particularly when you look at the front end. There's very, very few products, particularly financial products, that you have to walk in and buy or speak to somebody on the phone to initiate that sale or purchase. Whether it's a vehicle, whether it's a credit card, whether it's a current account, whether it's a personal loan, you can generally do it online, download an app, and away you go. So customers are very used to that. And what we generally find is that if you pull the rug from underneath the customer and remove all of the communication channels that they're used to using, you leave them bewildered and lost. Well, I could talk to you via email, I could talk to you via web chat, I could do two-way SMS before, I could log into my account, I could see what my balance was. If you remove all of that, then you're going to antagonise the customer. So digital, yeah, the clue is in the title. I am extremely biased. I've got a job to keep. I've got to promote digital as much as I can. But I do that because I actually believe that it's a worthwhile proposition. The win for you, or the win for you as a business, is the data that you get at the back of that. It's the insight that you get. You can see what your customers are reacting to, what is useful to your customers, what is not useful to your customers. And data shouldn't be, I said this to somebody earlier today, but data shouldn't be treated like a Times #1 bestseller. It's not just good reading. It's a roadmap. It's an indication of what to do next, and more importantly, what not to do in terms of engaging with your customer and propositions and options.
Yeah. I mean, I think we talked this morning about sort of like not being one thing or the other, but almost like a blended kind of approach, right? So do you use digital, but then you can pick up the phone and then talk to someone, from a human point of view as well, right? So, I mean, Dawn or John, what do you kind of think about that?
For me, especially given the current climate that we're in, being able to self-serve in the digital perspective from those people who are struggling is more important than ever. If you think of a normal collections environment that they would be in, people have slowly barreled into debt, or it's been a mountain that's kind of just built up over time to a thing that they can't get past, and then they contact you, right? But those people have potentially had time to read up, to understand what the kind of situation in, what they can help. You've got people here who this has just happened to them. As we pointed out before, this has just happened to them. I mean, the environment around you has radically changed. It's not because of your bad behaviours or bad decisions. It's not because you've gone out and gambled all the money you had left. It's not because of a bad thing that you've done or even a thing that you've profited. You haven't gone out and got anything new, brilliant, that you then have to repay, and you kind of didn't think about it properly. There are a lot of customers out there who are normally very good customers. That's why I said the credit risk CRA-based model does not always work, because these aren't situations they've been in before, and it's a big change. And you've made the point before, it can be like an embarrassing situation, especially if you've never been in debt before, to actually go through that process. And also, a lot of people, their modern lives just don't work around when a call centre is going to be open, right? So it's all very well going to go, oh, okay, they can call me at like 6 o'clock. Oh, great. Well, I'm back from home, but that's great. But when I get back from home, I cook dinner for my children. Then I spend a few minutes talking to my wife, and then I put my children down to bed, and then I'm exhausted and don't want to speak to anybody, right? The idea of someone calling me if I got into debt would be like, that's the last thing I need to do, because I've already got all these things which I have to do in my life. And these are people that this is happening to right now. People, hopefully won't be one of them right now, but there are lots of people in this situation that have never been in a situation before, especially those people in mortgages, right? So you've had doubling of mortgage payments. Some of these people are your prime, really good customers. If we don't give them an easy situation to contact us, a digital situation to contact us, they may never do so until the problems got worse.
Yeah, so we haven't really talked much about, I suppose, even with the digital side of things, but also around things like, people who might be in vulnerable situations, they might have health issues, they might have those kind of things. I mean, can you do that digitally as well? I mean, Dawn maybe, or Richard, I don't know.
Yeah, I think it's just about
Spread.
giving customers options. So, and being able to do things through an online and a chat or some other digital way of contacting us, is I think is a valid way of giving a customer a choice of how they interact with us, as long as there is interaction with us and working together with us in order to get themselves back on track and get back into sort of clearing arrears or at least going through a forbearance. As long as there is that interaction between customer and ourselves, I don't think it really matters what form that interaction takes.
I suppose, David, you wanted to speak as well about, I suppose you get into the vulnerability side of things and you get into that's more complex kind of situations in terms of understanding a person's situation outside of the financial numbers, which, is more mathematical. Right? How do you it's a much sort of softer skill?
I think taking a step away from that, again, I'm speaking just from our clients that we see. We have clients that do all of that digitally, but we also have some clients that digitally that's all they do. Now, the thing that goes through my head around most of this is that just because of the type of service or product they're supplying and the demographics of their customer. That's the key thing that we kind of see, and that we've got 2 clients I know that purely just do digitally. It's impossible to speak to someone on the phone, even it's almost near impossible to speak to someone over a chat. It's all done through specific messaging. But I think they get away with it because the average age of most of their clients is probably between the ages of about 20 to about 35. And then also the type of products that they're kind of they're leasing equipment, and it tends to be high-end electronics. So the type of customer they have, but both those examples there, I know from speaking to one of them about a week ago, they're looking at vulnerable customer type scenarios, but their whole focus is still doing it digitally. They're not looking to have the ability to build into their strategy the ability to pick up a phone and speak to someone. That's just not on their radar at all. But
the comment that was made earlier, that Sarah was making earlier around having different types of people who understand the situation, because I understand it from my situation in terms of if I was designing a product. One of the comments has been made around whether I understand everything. I don't understand everything. You have that within businesses as well. We also come from certain backgrounds. Do we need to have much more diversity in that and understanding affordability issues as well? It seems like it. I don't know. What do people think?
Yeah, I think, diversity on thought, background is just absolutely essential, and it's so much value adding. Just people just bringing, even the 4 of us have got, we're working in the same industry, but we've got very different views on things and just coming at things from different angles. So I think just being able, having that different perspectives is just absolutely essential.
But even in terms of affordability design
well, exactly,
and
yeah,
vulnerability
yeah.
as well, right? So that, and social care and those kind of things.
Absolutely, yeah, and understand, being able to understand different customers' positions, that people, and treat. I mean, it comes back to consumer duty again, as to treating individuals as people rather than just as a collective group of customers in arrears, because everyone is going to have different situations.
Okay. So again, we're almost at time. I'll try to lead a few of the questions in. Is there any sort of burning question that you want to ask? I don't know. There's a microphone as well. It might go the glasses. There's one of those microphones you can throw at the back. But.
Hi there. Thanks very much for all the views and stuff. I'm Andy from Webio. So just in terms of credit for refugees in England, I'm just really curious from your expertise. So obviously now there's over 200,000 Ukrainians in England, and seeing 3 Ukrainians come over and stay with my parents, and now they've become independent, building their lives, got their own house now. Kind of, I guess, would be categorized more as like prime type backgrounds from a professional and earnings perspective. Just seeing how difficult it was for them to get a broadband contract, and the difference in what I would get versus the deals they were getting, having to prepay for everything. What if they were to look to get a loan, like a personal loan, is there any options for those types of profile of people in the future, given that we don't have any sort of UK credit history on them?
To be honest, I think most of them would struggle. There is certain ways we'll be able to in the future expand our lending better than we do now. There is no international standards at the moment in terms of like credit file history to understand. I couldn't read a Ukrainian bank account. If you gave me the bank statement, I wouldn't know head or tail to understand of it. But there are things that are coming down the line which will help to some degree. So the European regulations in relation to credit file information as to what needs to be stored, who needs to save, who needs to provide that data and things like that will help cross boundaries if the credit file information providers will kind of get along with that and provide it to us as well. But things like PSD2, going back to the open banking or whatever, that is a solid structure that is European-wide, that is being adopted by non-European countries, and that similar regulations. Things like Plaid would be really helpful. So as Plaid expand where they're available, for example, that's really great, because Plaid can give me the information on a risk basis for people from America or or Australia or anywhere in Europe. So there is potential in the future, but I think that they will still be limited. I think open banking is the only potential for them at all, because they have got the ability to open bank accounts in the UK under certain regulations. HSBC, I think, are the only one that does it at the moment in time for those people. But as long as you've got that bank account open, you can show information, then open banking in itself, even just within the UK, will be helpful. It's the only way they'll be able to get it, I think.
Andy, I can give a perspective. So I was in Canada for 10 years, so I was an immigrant over there. And it was an issue, right? So it's always an issue. So I worked for Amex at the time, and we used to look at cross-border credit records to try and do that. But it was an issue when you had people who had PhDs with nuclear engineering from Europe who were going to go to the market, and they were it was very tough. But there are services out there, and some of the lenders I know have looked at it in terms of like, how do you translate credit files from different places across, but it is a challenge. It just takes a little bit of time, I think. So I feel for them.
I know there's definitely 2, because I know I've spoken to one of them, but we haven't spoken to the other one. They're coming at it. One of them's now saying exactly for that scenario, like you've said, but their original premise was to just go after the wealthy expat people coming to work in London in banking or in other professions, and what they were looking to do was to get cards into those people's hands as quick as possible. And my understanding was that it was purely done on open banking, and that was the only way they could do it. And even then, there's still some risk attached to that. But my understanding is they are now diverging away from just going after that customer. They're going after the Ukrainian immigrants as well.
It's an interesting debate, moving away from just pure bureau data to other forms of underwriting, I think, a little bit. So I know we're at time, so I want to ask the last question already for the panel, which is, so we talked a lot about arrears levels. We're starting to see some signs, maybe not huge signs yet, but it's maybe starting to bleed through. But what are the things that we need to look at today, like leading indicators? David, you may mention them, that we've got to be watching today to sort of protect ourselves from, affordability issues that are happening now that might cause risk in, 6 months' time.
I'd say, and I may be repeating myself a bit here, but I still find that data around the BNPL stuff quite scary. It's scary because there's data there that is important, but you don't know exactly how important it is. And I think, don't get me wrong, I'm not bragging that all BNPL is negative, but there is an area of it which I think is a ticking time bomb. And I think the numbers, as I say, we've seen going up, it does worry you a lot, because we could be opening, it could be a major problem in 6 months' time, I think.
Yeah. John?
I think for me, I'd like to kind of go in the back of that buy now, pay later thing, whatever. So, as you pointed out, the buy now, pay later is being pushed by a lot of retailers, especially during Christmas and things like that. So, my worry is for the retail sector, is that the buy now, pay later is one of the main things they're pushing on. The buy now, pay later funders they're finding it harder and harder to survive. Klarna and whatever are getting closer and closer to having major problems and kind of collapsing. But the other thing is with the buy now, pay later that I do worry about, because is that if and when those do collapse, that they'll take a lot of the retail sector with them. There's a lot of retail sector which is largely driven by buy now, pay later existing, and they're already seeing retailers fall by the wayside now, right? Some big, high-value retailers but falling by the wayside. And buy now, pay later, a lot of people thought it was really great that they didn't report on credit files. And now it might be their downfall. If you look at the Freddie Mae and Fannie Mac and whatever, and all look at the mortgage crisis, part of the reason that was bigger than it probably needed to be is because mortgages didn't used to report on credit files in the United States of America. So people were paying their credit cards before they were paying their mortgages because the credit cards made an impact on their credit score in getting the next mortgage, but their mortgage didn't. Mm-hmm. And the buy now, pay later things, if it gets out there that buy now, pay later doesn't report on credit files, well, why should, if I've got £1,000 debt to buy now, pay later, why would I pay it? You've got virtually no legal comeback if I stop paying it. Yes, it can be sent to a debt collector, but it's not enforceable in the same way. It's not a CCA agreement. So my concern is basically that there is a big wave coming in terms of buy now, pay later and these companies closing, and who they'll take down with them.
Well, so I suppose the closing of companies also affects people's income, doesn't it, for the employees, which can then...
For me, it's mainly the retail sector. The buy now, pay later companies have got reasonably small, comparatively, employee numbers. I don't think themselves going down is the biggest thing. It's basically the retailers that are by the base of it. If you go in JD Sports now, it's basically Klarna everywhere. If they stopped doing Klarna, I don't think JD Sports would sell much, and they'll probably collapse in about a week.
Okay. Dawn?
Yeah, I mean, on the buy now, pay later, I think it genuinely does worry me that, access to credit, particularly at the current time, is so readily available. And, JD Sports, as an example, actually isn't essential spend. It's not like your gas and your electricity. So actually, if people who are struggling financially are still being, justifying going to JD Sports, because they can get a buy now, pay later deal, that's a concern for me.
Yeah. And Richard, final words on...
Yeah, I'll just break the pattern a little bit down there. The buy now, pay later. I think for me, and I think generally from an industry point of view, but speaking from my point of view, I think the biggest concern is that ever-rising cost of living needs to be brought under control.
Yeah.
And I think we've some surprises yet to come. I think there's going to be other areas where we see price increases that we weren't expecting. And yeah, it's soon be Christmas, and it's a new year coming. But I think we said that about 2021. So don't hold your breath. I think 23 is going to be an interesting year, and I think the banks will burst at some point.
Yeah, that's right. But now's the time to get ready now, I suppose, in readiness for that. So I wanted to thank everyone on the panel. So thanks everyone. Dawn, John, David, and Richard, thank you very much for running through around affordability assessment.